Welcome,
Thank you very,
Bronwyn.
thank you very much, Joe. Great to be here at the Virtual Oil and Gas Summit, and looking forward to our discussion. Obviously, we're going to be deep diving into financing solutions for the industry that are needed to be considered by business leaders and governments alike at this very troubled time for the oil and gas industry at large. As Joe says, most of you have spoken prior to this engagement. Just running through the names briefly from a protocol perspective, I will go through. Tom Perkins is Director of Stella Limited. We have got Pearl Taylor, who is Head of Oil and Gas, Standard Bank, South Africa. Dr. Simona Santi, a businessman and investor based in Mozambique. Robert Nyasimi will join us a little later in the conversation. He's CEO of Rentco Africa. And John Clark, who is a partner at EY UK. And John, you haven't spoken prior to this engagement, and just a little bit more about John. He's an experienced corporate finance professional who leads EY's EMEA Oil and Gas Transaction Advisory Services team. He has advised on international acquisitions, divestments, and fundraisings covering around 40 countries globally and acting for international oil companies, national oil companies, independents, and financial sponsors. And John is a respected industry commentator with his insights appearing regularly in the media. Move now into the discussion, and I think, John, with that introduction, given that you haven't appeared on the platform previously, perhaps you could just talk to us about how you see the current challenges unfolding for the oil and gas industry, and we'll move into a second round of discussions when we talk about the solutions. But first, let's talk to the challenges.
Thank you, Bronwyn, and it's a real pleasure to be here, and it's a great sign of the power of technology that we can make an event like this successful. So thank you also to Joe for bringing all of this together. The oil and gas sector's clearly going through a number of challenges, as you allude to, and unfortunately, while there is hope in the world that we will emerge from the coronavirus crisis, I think there's less hope in the world that the oil price is going to recover quickly. And that's because the oil price is impacted not just by the demand side of coronavirus, but also by the supply side. And really, oil prices have been maintained by a pretty fragile alliance between OPEC and Russia, and arguably also the US. So there's always a risk that that alliance potentially unwinds, and that gives people concerned that the oil price might stay depressed for a little while. And that is having a drag on investments. It's also having a drag on the revenues that companies are generating. And for most oil and gas companies, certainly the bigger and more established ones, their sources of finance, actually their main source of finance is their existing operations, and they only go to the markets for new and large things. So that source of finance has dried up, and the market is looking at the sector and thinking, well, if we've got lower oil prices for a longer period of time, what is the hurdle that new investments need to jump? And perhaps that's slightly a negative start to this session, because I do think it creates opportunity as well. It creates real capital discipline. And for those projects and those companies that can demonstrate viability and attractive returns in a lower price environment, they're going to be seen as very resilient, robust places to invest in a world that is navigating lots of uncertainties in lots of sectors. So while a lot of the headlines are quite negative, there are some optimistic green shoots as well for the future of oil and gas. And I look forward to being part of the panel talking about both the challenges and the opportunities that are out there.
Tom, let's bring you in at this point. And earlier you were talking about mergers and acquisitions in specifically Africa and in the upstream environment. Just again, adding to what John has said here, can you give us a picture of where we are going from the challenges the industry is experiencing?
Yeah, well, I mean, I guess the first thing to say is the first half of 2020, there's no avoiding, has been a real tough time for the A&D and M&A markets. We've really dropped down in the levels of activity, and kind of looking into the crystal ball as to what's going to happen in the next 6 months to 12 months. Well, the way we see it is that we know that any market crash, as I kind of brought up in the presentation earlier, we know that new assets hit the market as a result. There was a feeling, certainly in our discussions with clients and companies who have been dealing in Africa, that perhaps the A&D market had become slightly stale. There was a lack of new opportunities becoming available. And as I said, with new opportunities hitting the market as a result of distressed sales, companies ultimately rethinking strategies, spinning off non-core assets, that ultimately does lead to a bit of a rejuvenation. And it's exactly what we saw in 2016 after the oil price lows in January 2016. Within 6 to 9 months, market momentum had returned, and we actually kind of reached a peak level in first quarter 2017. So our kind of outlook for the next 6 to 12 months is, there's going to be obvious challenges and hurdles ahead, but we do expect production-led acquisitions to occur towards the back end of the year. This is all underpinned, of course, by having some stability in the oil price. If we start yo-yoing between $40 and $15, of course, it makes it challenging. But if we can stabilize at $40 and at least get some sentiment that buyers and sellers can come together on valuation, we see that being the initial mechanism. But it is going to be a diminished buyer pool. There's no doubt about that. The capital has dried up for a lot of companies. So it is going to be a different buyer pool, but we do expect there to be a buyer pool to carry out transactions.
So a diminished buyer pool, but certainly there will be a different buyer pool. And Simona, let's bring you in, being an entrepreneur, investor in Mozambique. Who's going to pick up these distressed assets and prepared to dip their toe into the water without the stability on the oil price that Tom refers to? We need that $40 a barrel.
First of all, thanks. First of all, I think that we have to consider that we have to forget completely that the oil and gas price be linked to the real demand and supply. So I think that we understood after 2016 and this year, we understood that is more vulnerable price, and sometimes depending about what Keynes say, animal spirits, that in this case, what crazy animal spirits. If you remember, we got the situation that in the United States, it was minus $40 or something like that. So we have to consider that the oil price now is not so sensitive to the demand and the supply. And also the equilibrium of OPEC is very insignificant. The decision of oil, very insignificant. So we have to, well, for sure, the other things is that, and I think that Paul knows very well, that the financial system in this moment, because it's quite against the oil and gas, because it's not sexy, because the world has to be green. But honestly speaking, I don't think that will be green in the time that the world is expect, because we need to have the technology to be green as now the fashion green is becoming a real lobby. So this is the framework. And the other aspect that is very important, that's with the oil price crisis and with the COVID, we probably discover that the oil and gas industry is becoming a normal industry. That's usually the industry, oil and gas was the richest industry in the world, and now is becoming a normal industry that is suffering, that has to reduce the cost, that has to be competitive in selecting the project. There's not that big margin that used to have in the past. So it's becoming a normal sector. So all the competition of the countries and all the project has to be, first of all, cost effective and cost competitive. This is, I think, the main pillars that's positioning us as investors and as entrepreneurs in a new world for looking for the future.
let me bring you in, Paul, at this stage from a Standard Bank South Africa perspective. We have met at numerous oil and gas conferences and usually in the flesh. This is the first time we're doing it on a virtual platform, which obviously is our new reality globally at the moment. And thank you again to Joe for making this a possibility. But jump in here, Paul, with your thoughts and how the industry has changed dramatically since the last time we met from a financing perspective.
Within the region I look after, so Southern Africa and to some extent parts of East Africa, COVID has not been a dramatically bad set of situations. And I'll choose my words exactly and precisely as a result of that. So on the whole, the gas industry, and LNG in particular, has been less affected than oil. As of May, it's still correct that the IEA has shown that LNG demand went up year on year. The Mozambican projects that Simone is equally familiar with, those two have carried on going forward. And for every negative effect, for example, a Rovuma LNG has been delayed probably 12 months or so, you've had a positive effect. So Sasol last week publicly confirmed that they're looking to sell their Romco gas pipeline in Mozambique. The expectation we have is that when that's connected to a new LNG import terminal in Maputo, South Africa will have access to global LNG volumes. So that's a sort of example of it. Or another one is equally Total's purchase of Tullow's interests in Uganda, really pretty much a week after the minus $37 price that was referred to earlier. So it's not been a universally bad situation, although the industry dynamics that John's referred to are correct. You know, in elements of planet Earth, oil and gas is certainly under pressure, but it hasn't yet really hit Africa. At least the parts of Africa I look after yet. And then just finishing off with one introductory point, in Mozambique at the moment, you have the ongoing signing of the financing for Mozambique LNG, of which, you know, our bank was very proud to be heavily involved in. And the overall volume of finance raised, $15 billion, is equal to the GDP of an entire country. So one can get a little bogged down by the negative trends that have affected the industry as a result of COVID. But certainly in Southern and Eastern Africa, there is some room for cautious optimism.
So Paul, you are sounding a lot more optimistic than the rest of the panel. And I want to stay with you for a moment here. Let's pick up on the discussion point that Tom brought in, saying that there will be a limited pool of buyers, certainly diminished pool of buyers, and there will be different buyers. So are we going to see the industry makeup changing?
I think that's possible, but also for good quality assets, of which something like a Romco is a rare example, you're always going to get lots of buyers for good quality assets, because the good quality assets don't come up for sale very often. I mean, I remember years ago when I was in the UK, there was an old airports company called BAA, which had ridiculous bidding for it because it was selling Heathrow and things like that. So the same thing where a Romco, for argument's sake, is going to get lots of people looking at it, and then it's just a question about who has the best vision for the business, ultimately who has the capital, and what are they really looking to achieve over the next 10, 15 years in the energy landscape.
Joe, do you want to come in here at this point?
No, not right now. I will join us as we get into the conversation on what the speaker spoke about. But yes, I agree with them that, well, the situation is a bit different, maybe for East Africa, but of course for the world, other areas, they are feeling the pain of the current crisis.
Beyond the pain of the current crisis, and John, I'm coming in here to you, taking what Simona was discussing, in that the industry is almost normalizing. It is less sexy than it previously was. But he also mentioned the big push to renewable energy and the impact that has had on the entire oil and gas industry. Let's get your thoughts from a transactional perspective there.
Yeah, I mean, I think the observations from the different panelists are really interesting, because we all have a tendency to think the rest of the world is exactly the same as what we see outside of our own window. And when we're all locked down, the view of the world maybe gets narrower rather than broader. So it's great to hear the diverse range of views. I think the common theme in oil and gas is there's been a massive change in what the limiting factor is. We all grew up in a world where people talked about peak oil, and that was always talked about in the context of the world will run out of oil. So it's a supply side.
There's a finite supply of oil.
It's a
I remember
finite
the
supply.
argument well.
And I think that's why Tom and other businesses have really grown up in the let's buy and sell production assets. But actually the world has moved to the limiting factor being demand. At some point the world is going to run out of demand for oil. And that isn't tomorrow, it isn't next year, it isn't in 10 years' time. But the shift of many large customers, the integrated majors, has been to realize that the limiting factor in the world is probably demand. And that's why some of the deals that Paul was talking about, which connect the global supply into huge demand centers in Africa, bringing LNG into South Africa is a massive opportunity, and they're going to be hugely attractive projects. But the capital is shifting from what we would call upstream towards what we would call downstream. And I think if you try and contextualize that around Africa, there is a challenge and an opportunity, because there's great resources and there is great and growing demand, but they're not necessarily connected. And the countries or companies that can make those connections are going to be really successful. You then asked about renewables, and the sort of logical extension is, if people are thinking customer is the most important thing in their business, then the customer is an energy customer. It's not necessarily an oil and gas customer. You know, when you turn on your heating, if you live in the UK, or probably air conditioning if you live in Nairobi, you're not thinking about, is my electricity generated by gas or by renewables? You're thinking about, will the electricity work? So you become an energy customer, in which case it makes sense for companies to invest in both renewables and gas. And then I think burning oil is not the best use for it. So actually deploying that into more value-adding activities like petrochemicals makes sense. So you start to see this evolution in the industry around customer, and I think that's where renewables fits into it. And it's going to be fascinating how those worlds collide, because from a financing perspective and a transactions perspective, the sort of capital is just completely different between renewables and oil and gas. So I'm not sure it's quite oil and gas becoming less sexy, as Simona said. I think it's oil and gas having to sort of play on a level playing field with other parts of the energy complex.
That's, I think, a very fair statement, is the oil and gas having to play on a level playing field with other parts of the industry. Simona, I think if we can get you in, there was another point that I wanted to pick up on here that you had said previously, and that was that we've seen efficiency and cost efficiencies within the oil and gas industries coming out of this very tough period. So that is obviously talking to businesses being right-sized and operating at maximum efficiency levels.
Well, I really appreciate what the colleague said, because the key important thing is where is the market, where the market will be. And I'm 100% sure that the market in the future, the market will be Africa, because for sure now the demand of energy is very low and the supply of energy is very high. But the case of Mozambique is the case of this, is a part of the case of this story. So South African need 100% the gas from Mozambique, as Paul said, because they need the LNG, they need gas to power, and they need the power, and they need the power that now is coming also from Mozambique by the hydro, but they will become by gas. So they are, South Africa is as a planning of having a three port receiving the gas, probably from Mozambique, probably, and to transform the gas to power. Just now, the Total project in south of Mozambique that we use for sure the gas from the north is considering an hub that is Matola, close to Maputo, for the South Africa. This is what it means, that the future is using more energy coming from Africa for Africa. But this is, and we have to respect the cost. And that's why, as Paul said, we have two giant projects. That one is Area 1, as I mentioned in my presentation, that is the Total project that is running. The FID was last year. And the other one that is stopped for, we expect for the next 12 months. Why? Because they have to reduce the cost. So at the moment, Mozambique has, if we will have the FID in 1 year, they will have the potential to be in 5 years, to do the production in 5 years of what Qatar has done in the 14 years, the double of Qatar, the half of Qatar have done in 14 years. So we have to consider two things. If the review of the projects, and for sure, all the tier 1, tier 2, tier 3, they have to reduce the cost. If this gives the chance to the second project of Exxon, so area, in this case, area 4, to go forward, in this case, we will have in 5 years, Mozambique as a real competitor of Qatar. That was completely out of the imagination.
So you're saying Mozambique in 5 years could be a real competitor to Qatar?
I say that Mozambique will have the first gas in 2022, and in 5 years they can have half of the gas than Qatar had in 14 years. So in 5 years, we got 31.5 MTPA, that Qatar has 77. And if we go with the second phase of the project, we'll arrive to double it. So it means that Qatar now is looking at Mozambique as a potential competitor for the gas. But we have to consider, as John said, that it's very important that Mozambique actually is the future for Southern African countries, because gas to power is something that they need. And from my point of view, gas to power is energy transition.
So Simona, I want Paul Early-Smith to come in on the Mozambique opportunity, because I know this is very close to his presentation. But before I go there, Tom, I want to bring you in on a conversation point that John put on the table, and that was that capital had shifted from the upstream industry, which is where you very much niched, to the downstream industry. Could you come in there before I head back to Paul with Mozambique?
Yeah, no, I think it's an interesting point that John raises, and it's not something we're immune to when just dealing in the upstream environment. And actually sticking on the theme of gas projects, when you talk about gas and you talk about Africa, we're naturally drawn to the very large-scale multi-billion-dollar transactions, which we've been speaking about here today. But there's also a number of smaller gas projects which serve huge communities and are actually vital for local communities. East Africa, you've got SCDM in Cote d'Ivoire providing the gas there. And those are fascinating projects which, you know, ultimately start at the upstream, but are run right the way through to the midstream and downstream, and ultimately serving end users. And actually, it's very easy in this day and age to sit here and sound all very negative about the outlook for oil and gas and just the state of the industry. But those are projects and operations which, to this continuing making money, you know, they're in some ways immune to the kind of overall commodity price of oil and gas. Of course, if COVID was to really take a grip on sub-Saharan Africa, there would be a demand implication there. But as things stand, those are kind of projects which are working their way through, earning good money, and represent good opportunities for potential end users, but also in the upstream market if there is people looking to get in or companies looking to get into projects of that ilk. So there is opportunities there at this lower end of the scale, as well as, you know, if you can't get into the multi-billion-dollar projects or you don't have the GDP of a nation behind you, there are other opportunities around which are, you know, equally as important.
Paul, I said I was going to come back and delve into the Mozambique opportunity, following on Simona's sentiments with regards to how big Mozambique can become in the supply chain of oil and gas in Southern Africa.
Yeah, Simone's mentioned very well the big ticket implications, so I won't repeat it. What I will say, though, is really how, from a geographical breadth perspective and a new industry perspective, Mozambique is likely to start moving over the next few years. And I mentioned the sort of Romco transaction and its integration with Matola. I think that will be very interesting, not only to unlock South Africa, but also I would expect to see some innovations around LNG trucking, around LNG barges, that sort of thing. I would expect the number of countries in the region who purchase gas from Mozambique to increase dramatically. Once you have small-scale LNG, and we expect there'll be something at the jetty in a Fungian time, and that opens up markets such as Madagascar, Seychelles, Comoros, Kenya as well. So I think within sort of 5 to 7 years, you could see at least 5, maybe more Eastern and Southern African countries looking to buy LNG. And really this is in parallel with the ACFTA, the African Continental Free Trade Agreement, which is looking to start moving from this year. So I think the sort of next theme in Mozambique will be a continuation of the very large projects, with obviously a little bit of cost optimization here and there, such as Rovuma LNG, but more a broadening of the energy influence of Mozambique on the wider region.
The Continental Free Trade Agreement that you allude to has obviously been derailed to a large extent from a timeline perspective by COVID-19. So you can expect that all projects are going to be delayed, and there's little visibility on the end game here.
Yeah, I mean the general rule in sort of a number of sectors, whether it be the Ryder Cup in golf or football or anything like that, is just to add on a year, or the Olympics, to add on a year to your previous timetable. So if you had a various deadlines for certain things, let's call it ACFTA, you add a year onto that. But the general technical trend has not changed as a result of COVID. And it might be the case that, for argument's sake, small-scale LNG technology for trucks is better in 12 months' time than it was 12 months ago. So all of those sort of trends are occurring, and we continue to believe in the direction of travel.
Tom, I want to push a little bit further on Côte d'Ivoire. You mentioned the opportunity of operations in Côte d'Ivoire. We've spoken extensively about Southern Africa, Mozambique, but let's focus on West Africa for a moment.
Yeah, well, I think Côte d'Ivoire represents a very interesting opportunity. It's really been one of the kind of more active regions in West Africa from an exploration standpoint in the past 2-3 years. You've had the likes of BP and Cosmos come in there, take very sizable positions. Looks like they've subsequently have left without drilling, but you've got Total's, ENI's all there ready to do work. Qatar Petroleum has just come in with Total there. And of course, as I mentioned just previously, you've got the Foxtrot gas field, which is providing, I think, around 75% of Côte d'Ivoire's gas. So it's an interesting area. It's been very interesting to actually see how that's evolved, because naturally all the exploration and production took place really on the shelf, shallow water areas. Then people went out to the deep water, but actually there's still a lot of work to be done, we think, on the shallow water. And actually you've got Cairn and Tullow now targeting that onshore rift play, which sits just onshore, and that looks a real interesting play to see how that develops. But you've got a real vibrant community there to actually provide energy to with gas. You've got stranded gas offshore just on the border there with Ghana. So it's from our standpoint really a market to be tapped into, and it's a growing economy. And so find all your options there for developing that. But gas has a market, which has always been one of the challenges for finding small volumes of gas in Africa, is how do you monetize it? But Côte d'Ivoire, you can.
So John, we've really honed in on the opportunities on the African continent. Let's talk now about global opportunities in oil and gas, and where you see those opportunities, specifically with that financing and investment slant that we are gathering momentum on in this very discussion.
Yeah, and I don't think the ingredients for a successful oil and gas investment have necessarily changed. I think they've maybe all been put in a bag and shaken up a bit, and they probably come out in different order of priority. But projects which can operate successfully in a lower oil price environment, so low cost projects, are going to be attractive because they'll be more resilient if we do have lower prices. Projects which are clearly connected to a market, I do think demand and access to demand is one of those factors which has moved up the list quite a lot. And timing is another big factor. I think the future is uncertain, but the further you go into the future, the more uncertain it is. And particularly with oil and gas and energy transition, if you have projects that, you know, are huge upfront capital investments that take decades to pay back, they may be less attractive than ones that can be modularized and generate payback perhaps in phases and perhaps over shorter periods of time. So the concepts of timing, cost and market are all important. I think, and this is definitely not consistent everywhere in the world, but I think the role of carbon will play an increasing part in the attractiveness of oil and gas investments. And I know there might be people out there listening and thinking, well, all of oil and gas is a hydrocarbon, but actually not every barrel of oil or every molecule of gas is equal. The extraction of certain barrels is a lot more carbon intensive than the extraction of other barrels. Gas, as Simona said, I think will play a big part in the energy transition of the world. So I think for people trying to encourage investment, the role of carbon will be increasingly popular. I don't think there's necessarily, against that backdrop, one geography that's going to be more or less attractive than others, because I think people will be making the investment decision at a project level rather than necessarily at a country level. Although clearly some of the projects that Tom touched on in Côte d'Ivoire will tick all of those boxes. So, you know, understandably there is interest there from investors.
I just want to continue with this theme of global operations other than the African continent. Are there any other contributors to the global conversation? I mean, I like that very much, John, in terms of saying that it'll be project dependent rather than geography dependent. Simona, I see you nodding in agreement there. But are there any other views on the global conversation?
Right, if I jump in?
Yeah.
Just to leapfrog off really what John said there on the importance of timing, and I think, you know, that's a very good statement, and one that we're really seeing reflected in companies' public statements now. I mean, we've seen the likes of Cosmos very publicly say, once we drill out our frontier portfolios around the world, we're not going to go back to frontier areas. We're going to stick in basins that have infrastructure. We're going to monetize real quick turnarounds, because they hold the view that if I make an oil discovery, or if I get some frontier acreage now, I make a discovery but can't develop it for another 8 years, is the financing going to be there? And I think timing is really, for these public companies, at the absolute forefront of their minds. But I think that is a global theme. Geographically, I think we continue to see, you know, the real hubs, US market, UK market, have probably been two of the most liquid markets there are from an upstream perspective in the world. It's going to be interesting to see how the private equity kind of reacts as we move forward. We've seen really the hard realities that they've had to face in the US markets. And in the UK, I mean, just before COVID and the current oil price crash, you know, there were 3-4 private equity vehicles already set up ready to sell, and those have effectively had to stop because of the oil price crash. And we might see an actual change in private equity stance, similar to in the UK with Chrysler, where they effectively become a bit of a dividend-paying cash cow. They're not necessarily looking to that IPO, that M&A sale, because that market doesn't live anymore. It's a market that's really disappeared. So it's going to be interesting to see how that plays out. And there's going to be lots of examples to choose from, certainly in the UK, from an international standpoint.
Simona, it looked as though you wanted to pick up here.
Yeah, I agree 100% that it's very important the timing because for the energy transition. And for instance, the government of Mozambique, the Institute of National Petroleum, that's why is putting the new call for the new blocks, probably launching in this year. Why? Because in the next 10 years, nobody will know about the real demand of gas or real demand of oil. So it's very important for the government using now this opportunity as a boost for the rest. But I want to give you some entrepreneurial perspective. We mentioned about the COVID. COVID is a huge opportunity in this moment to discover again the local production. And now in Africa, in the African market, is you know, the African entrepreneurs are rethinking to do something locally instead to import everything from outside, because they are waking up and they say, oh, but okay, we need the world. This is one of the boosts. The energy is for sure the boost for the production, so the production and the transformation. And from my point of view, also the price, as we say, the optimization of the price is pushing to try to do locally what you usually import from other countries. So manpower is better to have local manpower train, or some you know, NDT inspection certification, or some services, logistics, some of these services, they usually in this industry are imported from abroad. Now they are looking for the real local content. So when we talk about local content, probably these three conditions of the price and the COVID and the huge amount, the big size of the project, they are pushing for the local production and local manufacturing. Do you think this is the real opportunity? In terms of geographically, I think that there's some example they give us the interest of Africa in this moment. Saudi Aramco, probably they will invest in South Africa. And from my point of view, there's a chance also that we'll invest in Sasol, but this is basically sometimes can be rumors. So if we see the game, the market of African gas is the East, China, India. It's quite easy geographically for the East Coast. And the interests are coming. Qatar are coming to invest. Saudi are coming in to invest. Indian, they already are investing with Total, as Paul knows very well, because they are financing the project. So why India, China, Japan, and only means Australia to invest in East Coast of Africa gas production? Because geographically, it's easy to support and to supply this area of the world that will grow after the COVID, for sure.
There's another theme that we need to touch on across the board, and it is directly linked to the long-term capital required in these projects from a financing perspective, and that is the regulatory environment in the territories where we find the opportunities. Paul, let's bring you in here just to begin the conversation from this perspective.
Yeah, so couple of sort of thoughts, and it's really picking up on what Tom's mentioned and also John. I think the next sort of phase of challenges are really market responses. So just a couple off the top of my head. Clearly, if LNG is now likely to go into South Africa, which it is over the next few years, then is the current structure and modus of regulations still fit for purpose? If you're introducing something brand new, good example being small scale LNG, and that was, you know, it's already been announced 2 weeks ago by Renergen and Total for the N3 motorway in South Africa. How is that going to work? You know, the price changes regularly, it's a different currency, all of those types of issues, they have to be thought through. And then just moving across to the West Coast as well. One of the challenges I think you're going to see in a number of oil and gas markets is pressure on fiscal terms. And for example, if the long-term oil price is no longer 65, but is somewhere either, you know, BP's 60, so Shell's 60, BP's 55, or Wood Mackenzie's 50. Does that mean that the fiscal provisions in markets such as Angola remain optimal going forward for the new types of investment? So that's a different type of regulatory pressure, where you have not a market technological development such as small scale LNG, but more a market price movement. And then if you're looking to do the sort of next wave of projects in markets such as Angola, of which the gas projects leap out, things like combination of gas and liquids projects in blocks 20 and 21 also leap out. Again, is the current regulatory structure fit and designed to execute those projects, or does the 2020s need a different type of regulation?
Sounds as though you're leaning to 2020s needing a different type of regulation. Simona, speak to your entrepreneurial experience with Mozambique specifically.
What the question, sorry, can you repeat?
The regulatory environment. So Paul very ably there saying, you know, are the current regulatory regimes in different aspects of the industry suitable for the industry 2020?
Well, I think that a lot of African countries, they are going to have the regulatory framework that is a negotiation with the oil, with the energy world. Also, just to give us a couple of examples, Nigeria and Angola, the local content law, I think they are waking up that probably is not the best law, as probably black economic empowerment in South Africa is not the best law for the energy sector. Okay. That's why, for instance, Mozambique, they take the decision at the moment to don't have this framework law, because they want to negotiate with the project a local content plan. It is make the difference what? We fix a budget that you have to spend locally for local indigenous company part, or for local company registered in the country. So it's kind of change culturally that is sometimes the local content law was a kind of a populism approach, politically populism approach. Now it's very practical. What we can transform locally and what we can put more value added locally instead to have this one for law. I think that the framework, also the regulate, that's in this kind of project, you have stabilization rules. When you approve the project, you have the stabilization of your contract. So it's mean that the government cannot change the rules when the project, after the project starts. So this industry is quite protected by the change of the government eventually. But as you can see, the African countries also, the African government is going in the direction to protect the investment, the foreign investment, because still we didn't the finance coming from abroad. Still we have a cost of our finance that is too high to sustain the development of the business. So still we need to have the partnership with the rest of the world.
Tom, globally, if we look at the regulatory environment beyond Africa again, you know, what are we seeing? Where are the most friendly territories from poised to attract long-term patient capital in oil and gas?
I think ultimately what people are looking for is stability, and you know, it's the word that you want to know that what I'm doing now is going to be the same in 5 years, it's going to be the same in 10 years. And that's honestly one of the challenges with Africa, and why certain companies, you know, don't elect to invest in African opportunities, because there's that uncertainty with stability. So in terms of when we think, well, what are stable environments? Well, it's ultimately where we've probably seen the most investment, you know, the UK North Sea, the US market, where in the grand scheme of things stay as they are, they're well understood. You've got big players operating there. Everyone kind of knows which way the blocks are going to fall. And, you know, that's that's really what it comes down to for us. You know, if you're working in a new state, perhaps you're the first mover, that has its advantages, but then of course that can lead to delays. We've seen what's happened in Kenya, Uganda, where there's just uncertainties, people coming to agreements almost on the fly as things are developing, and that's a challenge. And especially, you know, coming back to the timing thing, that's going to be coming more to the forefront now, because we're so much further along in the hydrocarbon kind of age. We can't afford to have a 10, 15 year, you know, redundant period where nothing's happened, because it's all caught up in frameworks and legislation. So, you know, stable areas is just where the money will naturally go to, because there's already enough risk on the demand side of hydrocarbons. Is that going to be here? You want to really limit your risks.
John, weigh in.
Yeah, I mean, it was interesting observations, because the answers you got would probably have been the same answers 6 or 12 months ago. And yet, I think the role of government in the world has changed massively. And we could probably have an entire panel on what might the world look like after coronavirus. But in a huge range of countries, governments have become far more involved in their domestic economies than anyone would have ever expected and most people would have ever desired. But actually, if governments hadn't have intervened, I think the impact on economies in many countries around the world would have been far more significant. So in the UK, for example, the government's racked up something like £300 billion of borrowing this year in response to coronavirus. And there are, you know, other governments around the world who are thinking about, well, how do they extricate themselves from that? But how do they do that in a way that isn't just cutting off funding, livelihoods, and in a way that's stimulating an economy in a future shape? So I think the role of government is going to change. The role of government vis-a-vis the oil and gas sector is also going to change as part of the energy transition. So I think the old answers of stability and don't interfere because we know what we're doing as an industry, you know, maybe need a little bit of a reset. And it's probably hard to speculate what all the different governments around the world will do, because in a lot of cases, I'm not sure the governments themselves have figured that out. But I do think the expectation is for governments probably to be more involved in the social agenda, more involved in the employment and job creation agenda, which goes to some of the points that Simona was making around local jobs. I think the evolution of supply chains will be massive, and trying to shorten complicated global supply chains. So to me, what government do is more than about just regulations for oil and gas. I think what governments are going to do in their entire national economies and social contract will play a huge part on where capital flows and where governments encourage the capital flow. So I don't have an answer, but I thought that was an important observation to make, because I don't believe that thinking as an oil and gas bubble in isolation is probably going to be possible from a government context.
I want to come back to the objectives that we were set at the top of this discussion. And one of those clear objectives was to provide solutions, possible solutions for business leaders, for governments in attracting investment and finance into the oil and gas industry. So I'm going to go through the panel for closing comments at this point, and very much put that point, that discussion point, back on the table. So let's look at the solutions in your minds as experts in the industry across a very broad spectrum of the oil and gas industry. What are those solutions that business leaders and governments can look to in the current environment to attract investment and finance? Paul, let's kick off with you.
Well, I think the start point is to recognise the areas that work. So, for example, classical LNG projects can still raise capital, as in the case of a Mozambique LNG $15 billion debt in the middle of COVID and a Brent crisis. So they're the sort of success stories. From the African lens, I think there's two things that come through. The first one is, although the drive towards cleaner energy and emphasis on cleaner is of course, just and irreversible, one should also recognize that it's simply not possible or appropriate for an African market to be judged by the same criteria as examples in the West. So to pick one example, which is it's quite appropriate, Sweden's GDP per capita in 2018 was $54,000 a head. Mozambique's is 499. So there's a huge difference between the two, and you would argue that ethically Mozambique has every right to develop its projects so long as they're done to best-in-class standards going forward. So I think that's sort of one point. The main credit challenge I would see is really the sort of consequence of COVID around the world is that governments have got financially weaker. So John rightly mentioned that governments have been asked to do more, but they've all got financially weaker, even the UK for argument's sake, or something like that. So when you then put it into the African environment, and especially when you get transactions that are a little bit gnarly, a little bit difficult, gas to power being the classic example, if you have weaker governments, you have even weaker SOEs. And how are those counterparties going to be able to fund and continue to service their obligations going forward? So I think, generally speaking, I've always been a big believer in pay-as-you-go type solutions in Africa, especially given the mobile, the internet, the DSTV precedents, and the more that they can come into the energy sector, especially in the retail environment, more's the better. But on the whole, I would still continue to believe that for well-structured projects in Africa, especially if they're either right-sized or serve a global market, then the funding will be there.
Tom?
Yeah, I think I'm going to slightly, not sidestep the question, but just kind of spin it more to my area, which is ultimately deal making and how we will attract investors from a deal making standpoint back into the A&D and M&A arena. And as I mentioned kind of at the very beginning, I think it's going to be a changing buyer pool. It's going to be certainly in the near term a diminished buyer pool. But I think we have to kind of accept that ESG is going to be, and environmental is going to be at the forefront of investments. And we're seeing that now more than ever. I mean, in any process we run, as part of any management presentation, as part of the sales pitch, there is an ESG component. What is the carbon intensity of this project? How does that benchmark against this? How does it benchmark against that? That's a real revelation, even in the last 2-3 years, that we're seeing right at the forefront of a project. That previously may have been buried, put at the very back, no one really casts an eye, but environment is now at the very forefront. I think personally, we're going to see, certainly in this kind of near to midterm, we're going to see private companies coming into the market who aren't under the same pressures that a lot of the public companies are in terms of raising money. They've got their shareholders to deal with, and you can't go on BBC News at the moment without seeing an ESG article, a climate change article, and so these companies are under pressure, less so than private companies, be that private equity, high funded net worth individuals, etc. We think we will see that kind of come into the buyer market and bring investments that will start at the production level, but usually trickles its way down into developments. And lastly, and it might sound negative, but ultimately not all projects are going to work. And I think we have to accept that. Projects, there's a lot, you hear in the market, there is just a lot of consolidation that needs to happen. And that sounds negative. It sounds like companies need to disappear, but the times have changed. The kind of single asset, I'll flip this, it's difficult. You don't see those success stories anymore. And we're going to see projects which might just not work the way they used to. And there's going to be a real favoring towards environmentally friendly gas playing a more of a role compared to 5-6 years ago. And I really see that taking off. It's more understood. The technology's there, and companies now have it as part of their agenda.
Simona, can I get a closing comment from you?
Yeah, I have basically 5 points to suggest to the eventual government for attract investment. The first one is to don't fall populistic measure or rules to the business. Give an example. Tanzania Tanzania basically, it's all the projects are in standby because they try to have a local content law that is completely out of the situation of the market and sustainability. So the companies say, okay, I will come back in 5 years if you change your rules. The second one is, I agree, is the stability, but the stability, I see that many countries are guaranteed the stability, also with financial problem, but we are guaranteed the stability to the project. The third one is to avoid the monopoly. The monopoly is the death of the business, and the monopoly increase the cost. So where we have the monopoly as a logistic or other kind of monopoly is a tax, increasing the cost and reducing the competition. So avoid the monopoly. The fourth point is to be very international and have the connection with the financial market. The money has not color, the money has not flag. In Mozambique, Exim Bank, United States Exim Bank invest more than 5 billion in a project where the operator is a French company, Total. So there's no color, there's no where they're coming from. Is the investment makes sense, the Exim Bank is financing. Because it's advantage for American company to work with. And the last is investing in communication and international lobbying. Unfortunately, most of the, we can say, the idea of make business in Africa is wrong. More than why some investors are scared is because the information that split in the world is worse rather than the reality. As an entrepreneur that invest the last 24 years in Africa, I can say the business environment is better than we unfortunately split as a communication in the world. So the government has to invest in communication and international lobbying.
And John, final word.
Yeah, I mean, I think there are 3 excellent summaries from my fellow panelists. I would say that you know, capital targets returns, and how you measure returns might have changed, and the things that are important to investors might have changed, but ultimately capital will target returns. And one thing that the last 6 months has taught us, whichever country in the world we're sitting in, is that you cannot predict the future. There are always things that are going to happen that you didn't expect would happen, and sometimes those things bring great benefits. I think the world of virtual conferences might be a massive beneficiary from lockdowns. But to me, probably the one word I would use to sum up what's going to make a project more attractive than the next project is transparency. And I don't just mean transparency in the sense of you know, governance and sort of predictability. I mean transparency in investors having more clarity around what are the size of resources, what are the potential costs to extract them, what is the timeline, what is the route to market, where is the market, what are the regulations, and the more transparency around the value chain, the more predictable returns might be, and the more likely capital will be to be attracted to those kind of opportunities. And I think that is the biggest change. We've grown up in an industry where, you know, as Tom said, if a company finds something, someone will buy it. Well, that's kind of relied on a value chain existing in the world. And I think the uncertainties of the last 6 months has taught us that the more transparency we can give to people around how those value chains actually work, the more likely people are to invest.
Gentlemen, thank you very much for a thought-provoking, honest discussion in terms of